Adrian Mowat, the EM equity strategist and a veteran equity market investor, is joining us now. Good morning, Adrian. Thank you very much for joining us earlier than we had scheduled. That's because the markets are looking so vulnerable. What's your sense? Do you think that we have a long way to go to adjust to the new reality of the higher cost of capital?
I don't think so. It reminds me a little bit of what happened in late January this year. You know, if you recall, we moved from 10-year bond yields of 2.4 up to around 2.8 in the month of January. The markets initially were very, very strong and then had a correction towards the end of that period, particularly the stocks that had been leading markets, as well as you started to see the beginning of the correction in emerging markets. So in the month of September, we went from 2.8 to around 3.2 on US bond yields. And I think we're getting a sort of belated reaction to that. But the way to think about this is that bond yields between 3 and 3.5% are really a sign of an okay US economy. And that as we get used to these higher levels, I would suspect that the equities that are still generating pretty decent earnings growth, which would include US equities, particularly the tech space, will stabilize and then probably continue their upward movement as they continue to offer good financial investments because we're still in quite a strong growth environment.
Good morning, but you know, this start of October has been quite brutal. If you see the month to date, MSCI Asia ex Japan is down 10%, MSCI emerging market is down 8%, MSCI India also down about 7%, which makes the year-to-date change now 15 to 16%. Is this a normal bull market correction in emerging markets, or are we looking at some kind of a bear phase in equities?
Well, I think there's really two markets going on here. So my earlier comments referred to what's been going on in the US market, and I think the headline is that US equities had a very large correction overnight. Emerging market equities have effectively been in a bear market since late January when they all began to correct. And there's been a few exceptions with that. There's been certain more defensive stocks, as we've seen in India, that have done okay, as have tech stocks, particularly the larger tech stocks such as TSMC. And you've also seen Indian IT performing well. But beyond those particular examples in EM, it's generally been in a bear market. So I think really the question here for the investors in EM is, are we about to see a more substantial, sustained correction in US equities, which clearly would bring global equities lower? I think we're going to have a tough October. But I don't think that the move in US bond yields nor the economic data suggests that we are moving from what's been a strong bull market immediately into a bear market in US equities. I think with regards to emerging market equities, you know, year to date, the EPS revisions have also been quite negative. The premium of earnings growth in the US over EM is more than 20% at the moment. So the dispersion in performance has made a lot of sense. The question for EM investors is, how much confidence do you have in earnings growth going into 2019? And obviously at this point in time, EM equity investors' confidence is relatively low as they try and work out what's happening with Chinese monetary policy and stimulus, a weak renminbi. In India, we're dealing with the effects of rising inflation with a higher oil price and a rupee around 74. In Brazil, there's perhaps a little bit more optimism about macroeconomic policy, but still some political concerns there, as is also the case in Mexico. So it's still a tough environment in EM. But I think the crucial question for October is, do you believe that we've come to the end of the bull market in US equities? I don't think we have. But clearly, it's going to be a volatile ride as we just get used to these slightly higher bond yields.
Well, the Asian markets are falling some more. So the Hong Kong market is now almost down 900 points. and the Japanese market as well. More than a 900-point slide is what we're seeing. Adrian, hi, good morning. So since you are saying that this is going to be a tough month of October and perhaps the sell-off in the US markets is not done just yet, what would your advice be to Indian portfolio builders? Is this the time to be deploying some money into the markets in, some of the market leader stocks, large cap names, or would you prefer to sit on cash now?
I'd much rather sit on cash at this point in time. I mean, remember that within EM in general, we've had a downward trend. Indian equities in local currency have been quite a significant outperformer. I would wait for some stability in US equity markets before deploying capital. And sometimes, you're better not to try and catch the low in markets, but better to have a little bit of patience, maybe not be able to buy at the lows, but be buying when you're more comfortable that the trend in the US equity market is reasserting itself, which has been generally a bullish upward trend.
Well, Adrian, how much further can you expect falls in emerging markets? Yes, the cost of capital has gone up, but last time around when the US economy was growing, I mean the big 2003 to 2007 phase, after the first bout of rate hikes, the markets got used to, we probably even saw a 20% fall in that rally at some point. But then the market got used to the higher cost of capital and believed that economies could still grow. Is there a chance that after this correction, people will look at the US economy as still a growth economy and that can lead other economies as well higher? What I mean is, can we get away with maybe another 1,000-point correction, even for, say, the Nifty?
I think that is quite possible because it doesn't feel like an environment where people are going to go counter to this trend until they become comfortable that the move that we saw overnight in the US is not going to turn into the US market moving into a bearish phase. At this point in time, the fundamental signals, which would be an improvement in the earnings outlook in EM, are not coming through. So EM is offering value in general across the indices. Positioning is now relatively bearish with the international investor. Now what we need to see is a bit of good news, and the good news typically needs to come through in equities with positive earnings revisions, and that is not the case at this point in time. I think it is possible that as we move into 2019, in mid-2019, you start to see better evidence of the Chinese economy beginning to re-accelerate. If that is hand in hand with greater comfort around the situation in Latin America, within India, that we become comfortable that inflation isn't forcing the RBI's hand, then I think the story for EM could be quite an attractive one. Okay. But probably that's a second half of 2019 event for the broad EM index.
Okay, well, we have Mitul Kotecha, the senior emerging market strategist of TD Securities, who also joins us on the phone line. So let's welcome him on board. Mitul, good morning. The MSCI emerging market index is now down 15% this year. Do you get a sense that this is the start of a bear market, especially in markets like India?
I mean, I think the reality is that emerging market equities have been underperforming for some time, and you just need to put a chart of U.S. equities and emerging market equities together, and you can see how they've diverged sharply from April, and that is something that, at least for the time being, doesn't seem like it's going to show any signs of turning around. The pressures that have been afflicting emerging markets continue to remain in place, and that's generally firm dollar, higher U.S. yields, Fed rate hikes, tariff threats, and generally strong capital outflows on the back of all of this. So we don't see respite in the near term.
Okay. So Mitul, what's your sense? In India itself, would you expect the rupee to take a bigger knock? We're already at 74.20. So does it go to 75 and turn, or do you think it gets worse?
Yeah, I mean, I think the rupee continues to weaken. I think the risks of breaking 75 have certainly increased, especially given that the RBI did not hike interest rates at its last meeting, as many people had expected them to hike, but that didn't happen. And I think, India and some other countries in Asia, such as Indonesia and Philippines, with current account deficits, continue to face pressure on their currencies because of capital flight, because of the fact they need to finance these current accounts. And in India's case, it doesn't seem, at least, as if the authorities are particularly worried about the depreciation. Yes, there have been some signs and some talk of, again, tapping NRI deposits, etc. But, I think the RBI action says a lot, or inaction says a lot. And I think for now, that means rupee continues to be under pressure.
Ray Faris of Credit Suisse is also with us. Mitul, Adrian, do stay on. Ray, good morning, and thank you very much for joining us in what must be very busy mornings for all of you. What is your sense? Are we going to see a big falls in all emerging market currencies and that feeding into equity flows, equity falls?
Well, I think at this stage you should reverse that. It's the equity flows that are going to really weaken the currencies. Most markets in Asia are down sort of 2.5% to 3.5%. And unless there's a rapid recovery in U.S. equities, then we're probably going to see, another wave of outflows. The current account deficit currencies, as we just said, are going to be the ones that are going to be most vulnerable simply because they need these flows to finance them, but they're not getting them. So the currencies will have to adjust weaker. The RBI's message, I think, is pretty clear. So much so that actually in the question and answer session of the press conference, if you remember after the meeting, there was a clear statement that the currency needs to adjust to the terms of trade change. And that was really a reference to the fact that oil prices have gone up, and a veiled reference to the fact that global interest rates are going up. And they prefer that adjustment to come through the currency than through a more rapid pace of domestic interest rate increases.
Adrian, I wanted your thoughts on, the way crude has moved, because the big reason for a fall that we've seen, especially in the Indian markets over the last 5 or 6 months, was the huge rally we saw in crude. This morning, at least there's some relief there. I mean, it's sub $82 a barrel. You think that would matter at all? Or now do you think, the global equity sell-off has taken center stage?
Yeah, I think it's very difficult to judge the overnight moves in commodities as indicating that you're going to get a change in the supply-demand trend. I think there was a broad risk-off move, and commodities suffered from that, including oil. The environment we're moving into, though, is one in which the oil producers seem to be moving at pretty full capacity. We begin to have Iranian sanctions really biting as we move through the fourth quarter of this year. And so I think we still are in an environment where the oil price will remain elevated relative to the averages that we enjoyed in 2017.
Well, Ray, do you think emerging market currencies are anyway close to a bottom? Because we have seen them falling rapidly for some time now? Or do you think this market turns only when the Fed acknowledges that, yes, we don't need to hike rates as fast as we originally said? Will the markets turn only when that message comes from the Fed?
I think the first criteria is that the dollar clearly turned weaker. So, as I've said before, emerging market currencies follow the trend in the dollar, and although the dollar's chopped around a little bit over the last month, that trend has been toward strength rather than against the major currencies rather than toward weakness. And that could very well be the case for another couple of months, but I tend to think that the dollar will gradually revert to a weaker trend in 2019. And in the very short term, there has to be some return to stability in financial markets. If there's going to be a further correction in U.S. equities, well, for a period of time, that's going to translate into more portfolio outflows from the EM asset class, really equities as an asset class, and that's going to take some of these currencies a bit weaker. One thing to note, though, is that, as we are trading right now, the currency weakness that we're seeing today in the rest of EM Asia is not nearly as bad as one might have thought before markets opened.
All right. That's some consolation. Thank you very much, Ray Faris and Mithil Kotecha and Adrian Mowat for joining us and giving us some cues that we have to look at. That's a small consolation. The Asian currency sell-off is not as brutal as one would have expected, looking at the way in which equities have sold off. But today, it is the equity markets which are going to, fuel more sell-off in currencies.